All right, today we are excited to be with Barry Brooksby, the founder of Focus Wealth Group, and we have John Malone, the co-founder of Anomaly CPA. So my name is Greg, and I'll be hosting this brief webinar today and want to hear a lot about what's going on in the world of taxes, the economy, and some solutions for business owners and real estate investors that we're going to bring to the table. So Barry and John, welcome.
Thank you.
Thanks, Greg.
Well, happy to have you guys here. So as everyone knows, right, we're in an election year. In an election year, taxes are always at the forefront, right? There's stuff that's thrown out there. A lot of people don't understand what's going on. A lot of tax questions being thrown out. But what we do know is that tax rates are going to rise, whether they're in 2025 or they're in 2030, right? Economists have said that tax rates have to rise over time because of the national debt and the ability for the U.S. to pay interest on that debt. So that being said, I'll ask you first, John. Taxes are top of mind for most people, right? And if taxes are going to go up, and they're probably the top 2 or 3 expenses in the business, how should a business owner that's scaling their business, how do they think about taxes? How do they approach their CPA, their tax counsel on tax mitigation?
Yeah, I mean, I think it boils down to the difference between tax strategy and tax planning and just overall tax compliance, right? I think there's a huge difference between the two, and that gets lost. And I think a lot of people don't understand that, right? In tax strategy is and planning, which are synonymous. Those two initiatives are what's going to really drive the needle for you. And really that boils down to being proactive throughout the year, right? Like when December 31 hits, like when midnight strikes on New Year's Eve. Like there's nothing more that you can do. I mean, I shouldn't say there's nothing. There are things that you can do, and there are there are avenues that you can look into, but they become much more limited when you're not really taking a proactive approach. So I would always recommend that whoever you're working with on the tax side, from a professional standpoint, if you are communicating with them throughout the year, you're identifying opportunities, you're executing on those opportunities. That's what's really going to set you up for this, this climate that we're in, where we're expecting, like you said, Greg, tax rates to rise, to service a lot of, kind of the initiatives of the government and the debt.
That's wonderful, John. So it really sounds like there has to be an active focus here on strategy and planning versus just letting the chips fall as they may, right? Tax compliance. So that's very, very interesting. Now, Barry, on your side of things, right? So you've worked for years in the financial industry and having different experience in the financial industry. Oftentimes people are allocating a lot of their money into financial investments, which can have higher taxes associated with them over time. What are you seeing right now from a market perspective, your clients, your business owner clients' perspective? What are the fears that keep up there at night? What are they concerned about? What are the things they're thinking about from an economic perspective here as we're going into an unknown territory?
The big fear is taxation. They are concerned about writing those large checks every quarter to pay the taxes, and then come April 15th, how much more are they going to have to pay? And as we see, national debt, $37 trillion, you mentioned it. Taxes have to go up in order for that to get paid, or government spending has to go down, which we know is highly unlikely, right? The government doesn't function that way. Business owners want to pay less in tax. They want to do great business. They want to grow, but they're also feeling the pressure of this tax burden. So what does that look like in the future? And there are solutions we have where money can grow tax-free, et cetera. But taxes is a huge part of a business owner's concern. They want to focus on their business, making money, growing that business. They don't want the worry or tax issue hanging over their head.
No, that's such a good point. I think that on our side too, on the CPA side, we hear a lot from business owners that they're surprised, right? They're like, wow, how can I be paying this much in taxes? It doesn't seem right. And oftentimes it's because there's not a budgeting system in place. They don't understand the amount they're going to pay, and they get this massive bill. They don't have the cash flow to pay it, right? It leads to a pretty ugly situation. So taxes are definitely something that are top of mind at all times. And look, most business owners want to figure out how do they stay in compliance with the law, right? They want to do what they have to do, but they want to make sure they pay the least amount legally liable. There's an old federal judge that once said, a taxpayer doesn't need to pay a dime more than what they're legally entitled to do, right? So we mostly find people that are overpaying their taxes. Now, John, when you take in a new client comes in and the team is working on a tax strategy, what are some like the common things that people are overlooking from a business owner perspective, or like what are the different general areas that business owners can be thinking about or even approaching their CPAs to optimize?
Yeah, sure. I mean, it kind of runs the gambit, but I think I can speak to what we do and like some of the main topics that we really kind of want to understand what our clients doing and then optimize for them. And the first is like entity structuring for our business owner clients. Like, what entity are they in? Does it make sense for what they're doing now? But really, does it make sense for what they're doing in the future? Right. So like, if they're looking to bring on investor capital, are they looking to exit at some point? Right. There's always the tax planning for the here and the now, but also into the future for the business. So entity structuring is a big part of that, in how the entity is being taxed. Like that is kind of like foundational where we would start. And then from there, you have your kind of what I would consider a little bit more lower hanging fruit, right? Like, are they optimizing all their business deductions, right? Do they have a system to do that? And are they really taking advantage of every dollar that they can deduct that's allowable by the law? So that's a big part. In conjunction with that are just tax credit opportunities. Those aren't going to be available to every business owner, but that kind of coincides with what you're saying. What you were saying, Greg, is like following the government incentives, right? We always want to be following those incentives. With rising tax rates, there's still going to be incentives too, right? There's always going to be there's going to be opportunities that the government lays before business owners and investors, and tax credits are a big part of that. So are they taking advantage of all tax credit opportunities? And then, after that, we kind of get into a little bit more like the nuanced opportunities, right? Like tax deferrals, right? Like, are they deferring their money appropriately? Are they in the appropriate pre-tax, post-tax buckets? That Barry can talk about a little bit more. Are they looking into life insurance products and kind of these other items that Barry works with that can really kind of form this tax-free bucket, right? So there's that portion of it too, and then there's a lot of investment allocation. Are we looking at capital gains? What capital gains are coming down the pipeline? And are we really putting together a system that makes sense together, given everything that they want to do? I think the biggest part about it is, we want to analyze everything that they have going on now, but we want to analyze it through the lens of what their vision is going to be. So we're kind of tailoring the plan to who that person is and what they want to do, right? Because no two people no two people really invest the same way, so they shouldn't really have the same tax planning and strategies.
Yeah.
And so I think that's important to consider as well.
That's great. That's all great points there. And it sounds like a very holistic methodology, which all business owners need that holistic methodology, right? Because not each business owner is a little bit different in how they should be approaching, their subjects. So Barry, on that same topic, right? John mentioned, there's a mix of planning for people. And I think that one of the things that is like very traditional that business owners and just people in general have been taught to do through education, through schooling, and through generational planning is deferral, right? So the common thing like a 401k and IRA. Now, they have a place in certain businesses. They have a place in certain portfolios. The deferrals do. But if you go back to the original point we made here is that all the economists are saying there's a guy out there named David Walker. He was the former comptroller of the U.S. that like is waving the flag for years. Like, we're not going to be able to service this debt in a certain period of time. So taxes will go up. Now, if one is deciding to maximize their deferrals every year, I think the thing that we always tell them is say, look, if it really makes sense and everything makes sense to take a tax deduction today, okay. But if you're not getting a large tax deduction today, all you're doing is setting yourself up for a tax train in the future. That future could be 10 years, 20 years, 30 years, 40 years. No one knows what the rates are going to be. When we're 60 years old, the rates could be like 50, 60%. I have no idea. None of us know that. So how do you think about deferral, Barry? How do you think about, or do you think about deferral at all versus post-tax or tax-free products?
Very good question. And this really is right to the heart of a lot of people's concerns, but many people also don't understand it completely. So think about it like this: 3 tax buckets: tax deferral, taxable, tax free. When I ask people the question, which tax bucket do you like the most? 100% of the time they say tax free. Okay. But then the next question is telling, which is, okay, where is most of your money? And they all answer tax deferred. So you are right. The 401ks, the IRAs, they do have their place. And I'm not saying don't ever put money into tax deferral buckets, but you have to understand that when you take that money out, it is 100% taxable. You're not getting away from that. And you might be getting a break on your taxes today, but if you are in a higher tax bracket later, you'll probably pay more tax on it than had you just paid the tax today. So my focus is helping people not only grow more wealth, but put more of their money into the tax-free bucket. That's what we all want. Why aren't we doing that? It's because we've been educated by Wall Street and financial advisors. You've got to go with the 401k, you've got to go with the IRA. And CPAs out there that don't know what they're doing, fortunately, you guys do, and you really advise people well on this. But a lot of CPAs are saying, look, I'm going to make myself look really good this year. I'm going to show this client this huge tax deferral. They're not going to pay as much tax this year. But the CPA is leaving out the second half of the story, and that is, what about all the taxes I'm now causing this person to pay in the future? So I help people put money into tax-free buckets. And from a tax planning perspective, you should have all 3 buckets in your portfolio: tax deferred, taxable, and tax-free. Unfortunately, most people don't have the tax-free bucket.
Yeah, I think that's such a good point there. And when we bring a new client in, we often do ask those same questions, right? And we actually ask the question, what do you believe is going to happen to tax rates in the future? Because I don't know. None of us really know. And I like to understand if the client, what do they think, right? Because I would say the vast majority of people answer that question. They say, we think they're going to go up. We just don't know when. It is very rare I run across someone that thinks the taxes are going to like long-term go down. It's a very rosy point of view. And I wish I had that point of view. So most people believe they're going up. Now, if you believe taxes are going up, why would you set yourself up for future higher taxes, right? Especially if you're a business owner that expects to do well. Because if you're doing well, you're going to be in a high bracket no matter what, because you're making money. Even in retirement, you're making money. You would have a high tax to pay on that. The most of our clients we work with are that younger generation, right? So we're not dealing a lot with RMDs and things like that. But we do have some clients that have hit that RMD phase. And we had a conversation with a gentleman, a former business owner, and deferred everything, right? And now he's in a point that he doesn't even want the money being taken out, but he's being forced to take the money out, and he's paying a fairly large tax bill on it, right? He's, as he says, like, I am very rich on paper, but I'm not really rich, in reality, because the government's saying, hey, you made a deal with us back in 1972 or 1980, whatever the year was, you got to pay that back now, right? And you're paying it back at the rates we tell you to pay it back. So like you said, Barry, I do believe, John does believe that you do need all 3 buckets: a taxable bucket, a tax-free bucket, like you talked about, and a deferred bucket, right? You got to, just like anything, you got to hedge, but you got to be aware that tax-deferred bucket will come home at some point, that will come home to you, and you got to be aware of when that happens. So we often talk, John, maybe you can talk a bit about like strategies, right? About converting things from the tax-deferred into a tax-free. You want to talk a little bit about that and when that might make sense for a business owner to think about?
Yeah, and part of it was a point that I was just going to make is like, like we do believe that like all 3 buckets are super important. So, there's by no means are we diminishing one or the other, but it's just that the common strategy that I think is more universal is that, you need to stuff a bunch of money into deferrals, and that's just not, that doesn't make any sense when we're taking into account the totality of the circumstances. So like, even leaving aside, if you think tax rates are going to rise and that's going to be kind of the main driver in what you do, you still need to look at your entire situation, right? Because we like, for example, like with our clients, like we may be, we work with a lot of alternative investors, whether it's in real estate or otherwise, and we may be driving down their effective tax rate through other strategies, right? Like, and why would it make sense if you have such a low effective tax rate through other strategies to be putting money in deferrals, right? Like, so that's like a part of it too. Like it all comes together and it needs to be cohesive. And that standpoint kind of parlays into your question too, Greg, is like, if you have kind of one of those, if you have, a year where, maybe income is down or you're taking advantage of these strategies, that might be an opportunity to convert, some of that, that pre-tax, those deferrals to, a post-tax account. And then it can also be offset with other, you can time it up with strategies that you're executing, whether it be, through real estate or otherwise, right? So I think those are the things that we're looking at. I mean, it all comes back to the point where, my original point where, planning is a super, from a tax perspective, it's very nuanced, it's complex, and the whole picture needs to be seen, business, personal, otherwise, so you can kind of put the pieces of the puzzle together.
No, I love that. I think that, like you said, John, why would someone, if you're going to execute all these strategies, there might be a year it doesn't make sense to be doing deferral, right? Like, I think what we often tell people is, hey, this year we've driven down your tax rate pretty low. Put as much money into the post-tax as possible, right? Because that's all tax-free growth. Don't worry about the tax section. It's like 10%. Doesn't really move the needle for you. So I think people are going to be aware of that because, Barry, to your point, there is some lazy advice out there that there's the common thread of, hey, no matter how much money you're making, no matter what your situation is, maximize your 401k, right? Or your IRA. Doesn't always make sense. It's really an individual year by year situation. And I think oftentimes the advisor is not putting enough attention into that situation, and the person's getting a deduction at like 12% effective, and they might pay that back someday at like 30% effective, right? So if people think about it that way, they probably wouldn't make that deal. The only other thing I'll say about retirement plan before I move on here is that it's interesting that in the last couple years, the government, the Congress, has actually really increased favorability towards Roth, which is post-tax, because we have such a short-term budget crunch. They're trying to get more taxes paid today, aka they want to give you a higher ability to get money into post-tax accounts like Roth because it makes you pay the tax today. So they want both sides of the coin, right? They're going to kind of sweeten the pot for the Roth people, and they also want people to kick the can if you can because they'll get more money down the line. So it's just you have to realize with those accounts, they have their place in planning, but you're making a deal with the government. That deal is one-sided. There's nothing saying Congress can't change the rules on the 401ks down the line. So you just got to be aware of that, if you're going to go down that road, and just make sure it's well thought out and you have someone on your side every single year. So
yeah, and I think I think like that illustration is like a fair point to make. Like in its simplest form, if people are just like looking at their effective tax rate and it's 20%, and you're one of those people that are, if you know that the tax rates are going to rise, like it's kind of a simple analysis. Like, do I want to save, X amount of 20% now, when I could be paying, 40% into the future, right? So I think that's just it's kind of a simple but powerful way to kind of describe the situation that some people are in.
I love that. Yeah, I definitely love that. So shifting gears a little bit, and we'll talk some of these tax-free items here. So, Barry, you specialize in something that's called a lot of different things, right? Some people might call it infinite banking. Some people might call it overfunded high cash value life insurance, and it can be very complex for people. So, what should a business owner that's considering a tax-free growth strategy, how do they think about this? And like, what are the basics to get their head around this subject?
Yeah. So infinite banking, high cash value whole life insurance, overfunded life insurance, it is all primarily the same thing, but it's all based on a properly structured whole life insurance policy. And I say properly structured, I really want to emphasize that because most agents out there are not setting these policies up correctly. There are writers you have to have. You've got to use the correct companies and then even the correct product. But when a business owner allocates funds to a policy, they have paid tax on those dollars. But now the money, once in the policy, it's growing guaranteed every year. It's not tied to the market. They get a guaranteed rate of return and they earn an annual dividend from the insurance company. The cash is also liquid. We haven't even talked about this. You put money in a 401k or IRA, you can't touch the money till you're 59 and a half without paying a penalty, right? But in these policies, the cash is liquid 30 days after you start the policy. So for a business owner, that's a huge benefit because they can then take policy loans, invest in equipment, they can go buy real estate, they can purchase some vehicles, they can use the money for whatever they want, hence the term infinite banking. But the most fun, the greatest benefit I see is now all those gains are growing tax-free. And technically they're growing tax deferred, but I teach clients how to take the money out tax-free. So 100% tax-free use of the money. All gains, everything there that not only you've put in, but all the increase. So you can use the policy now as your own bank, 100% tax-free. And the person is also setting themselves up for a stream of tax-free retirement income. And we show people their specific numbers as they go through the illustration process and our process with looking at their own numbers. Business owners generally will allocate anywhere between 5% to 20% of income, right? Every policy is different. Every business owner is different. The more money they put in, the better, because then there's going to be more growth over time. But here's a cool thing. All these policies have premium flexibility. So here's just a scenario. Let's say a business owner is going to throw in 50 grand a year. They're not locking into that for the rest of their life. They could put in 5 grand a year some years, 30 grand other years, and back up to the 50 in the following years if they wanted to. So the flexible premiums really give a business owner the ability to plan, like you're saying, from one year to the next. If they want more tax-free income in the future, they'll max out what they can inside of the infinite banking whole life policy.
I love it. So one way I have talked about describing this concept to people is there are 2 ways. Number one, if you look at what you're doing here functionally, right? So you're investing into a product. That product is growing. It's in this particular product, right? It's typically a safer rate of return with dividends, and you're going up. Now, when you're ready to make that investment, there's 2 options. Number one, you pull your cash from, say, a checking or savings account, or maybe a brokerage account. When you do that, the value of that account physically dips down, right? You take 50K out, it dips by 50K. If that was in an investment account, your compounding goes down to 0. In these policies, you're able to borrow that money back out. But if the same example of 50K, it continues to grow at that rate of interest as if the money did not come out because you're borrowing against your policy. It's a really important concept that people understand. I compare that to what do the Musks, the Bezos of the world do? Functionally, it's a very similar thing. They are leveraging, not their life, they probably have life insurance, but they're leveraging their large stock holdings or large business. So they're taking leverage against their business holdings, which are extremely high on paper. They're taking that debt out, and they're taking that debt and they're not going on vacation. They're taking the debt and they're investing into other companies, to other businesses they have, to real estate, to different things. And then they're going to take the cash flow from that second investment and pay back that debt on Apple or on Amazon or whatever they're leveraging against. So like functionally, it's the same thing that you're doing here, right? You're leveraging an asset, you're using debt. And if you're a business owner and you use that debt appropriately for business activity, real estate activities, you can actually likely deduct that debt as well, right? So you're buying down the interest cost there, and then you're paying back off of cash flow. So it's really a good cycle. And the key point is you're not losing compounding on the growth versus taking it out of a different source. You likely are. So we like to talk to people about functionally what that is. The second thing I'll say is one way we've gotten some other people's head around this is I tell people to Google PPLI, Private Placement Life Insurance Congress, right? PPLI is like the varsity version of this where the billionaires do, right? They're using these complex, very similar product, and you correct me if I'm off on that, Barry, but they're very similar conceptually, except for the PPLI policies are more in riskier hedge fund type investments, right? They're in a lot riskier of an underlying investment class, so they're more expensive. higher wealth. Congress hates them, right? Congress hates them because they're using the laws to their advantage and they're making a lot of generational wealth off of that product. In fact, Congress is talking about they'll never change the laws, right? But they get all upset and they do these reports on PPLI and the billionaires using it. So it's kind of the same thing, right? Like the highest 1/10 of 1% are using something very similar to this, just a little bit more complex of a product. That's how I like to describe it to people is in a business owner's portfolio, this tax-free bucket has a really good application if you put it to use. And I think, Barry, the worst thing someone can do, in my opinion, is if they have one of these policies is, number one, do nothing, right? It just sits there. Or number two, they borrow the cash out and they just like go on vacation with it, right? No, not saying you can't do that, but that's kind of upsetting the point of this, correct?
Yeah, it is. The number one goal when you take a policy loan should be to go purchase more assets, right? Create more wealth. And you're spot on. It is so powerful to think that you can take a policy loan and you're still earning interest and dividends on your total cash value. You're making money in two places. So if you're a real estate investor or business owner, you're making money in the real estate or your business, and you're still making money in your policy on your total cash.
I love it. So, John, kicking into you now, like you've been involved with multiple clients setting these policies up on the tax side of the house and on the business advisory side of the house. Like, what are some ways that you've seen people use these policies to their advantage, whether it's from their business perspective or maybe it's from an alternative investment perspective? Like, what are some functional wins you've seen people had or areas you've seen people utilizing these in?
Yeah, I mean, I think what Barry said, I don't think I've ever heard that one, that you're making money in two places, but I love it. I think that, and that's just it. Like, that's what underpins the whole thing, is that you are still continuing to grow the total cash value as if it had never left, and you're leveraging that to go buy more assets and generate more cash flow. So I think if I think about like the main use case that we talk to clients about is probably rental real estate, because it's a cash flowing asset. So what they're doing is maybe they're borrowing, they're loaning against their infinite banking policy, potentially to fund the down payment on a rental property. And then they're leveraging the rest through your traditional financing or what have you, and then they're taking that loan against their policy at say 5%, and then when the property starts to cash flow, they're paying back that policy. They're being an honest banker. They have, this is all documented, and they're paying back that policy at generally a higher rate, so they can kind of earn the arbitrage on the investment activity. So that is kind of what we see, and what we if we're talking about a model scenario, what we would preach. The other part of it, I think, is just when we're talking about our clients and the successes that we've had with our clients in this, is really just the lack of friction and the ease of getting a policy up and running, and the actual mechanics of getting this loan. We're not talking about this like arduous paper process. This is just open up your phone, hit a couple buttons, pop in a number, and you're talking about the money being ACH'd in a number of days, right? So I want to also like get out in front of that, is like, we are not talking about this cumbersome process to get money, get your cash value out on a routine basis.
That is such a good point. And Barry, one thing you taught me was that I think business owners or investors need to change the mindset, right? Because there might be people out there that have term policies and different insurance products, right? And they feel like they're like, hey, this is an expense I have on a monthly, quarterly, annual basis, versus the concept of this is just an investment you're making, right? It's an investment that's liquid. In fact, if you have a great opportunity to come up in 3 months, you're able to borrow a fair amount of that back out and take advantage of that opportunity. So I like to tell people it's not a expense that's coming out of your bank account. It's an investment that you're making into your future, but also an investment that's going to be liquid in case you have a different opportunity that comes up. So I think that mindset shift can be very important for people as well, just on what the typical person thinks about insurance. Do you agree with that?
Definitely agree. I like to call it a guaranteed investment. Think about this. Where is most of your money? Do you have something that's guaranteed to grow every year? Do you have something that's liquid within 30 days? And do you have something that's growing tax free? Most people's answer to that, Greg, is no. So we're saying this product of high cash value whole life and the infinite banking concept, it becomes a true asset in your portfolio. And you get all those things plus many other things. A permanent death benefit that isn't going to expire, like term insurance in 20 years, legacy planning, estate planning. There's so much to this, even creditor protection. Depending on the state you live in, there's some little minor nuances there. But the benefits are stacked over and over on top of one another. Those are the main three. And most people, they can't answer yes to that they're getting any of those benefits, let alone multiple benefits.
No, that's such a good point, Barry. And I think that something we hear all the time too. So it's definitely a lot of people have those kind of common threads there. Just a couple of things I want to touch on here. So we talked a lot about the different buckets, right? There's the taxable, tax-free, tax-deferred, some holistic ideas about planning. But, John, I'll kick it back to you here. So, you've had a lot of success in tax strategy and tax planning and having different points of views on it over the years. Most business owners that we see that come in have a lack of to no tax strategy in place. Most people tell us that they're getting in contact with their CPA or tax person once per year, and they're upset with the result that they're getting once per year because they're just preparing their taxes. That all being said, tax strategy, as we've just kind of talked about, is multifaceted, right? This is just one topic within the broader thing of tax strategy. The tax code is approximately 80,000 pages. We don't know all of it, of course, not even probably half of it. It's a very complex area, but so it's very overwhelming at the same time. What if there's one thing or one or two things you could tell a business owner about thinking about tax strategy, approaching their CPA, finding a group like us? Like, what would it be? What would be that one thing you would tell a business owner about the concept and the topics of tax strategy?
Yeah. We definitely don't know half of it. So we definitely don't know that much. I think the cop out answer would be, that they have to be proactive, right? Like that's kind of what we talk about. And that's true. I think taking that a step further is, and I'm taking this from, the successes that we've had with clients and what is like the common thread is that there has to be like, they have to buy in, right? They have to buy in and they have to put in their own effort into doing these things. Like as advisors, like we can come, like our job is to identify the ideas, right, that apply to your situation and then put them into place. And, and in most cases, at least for us, like we're doing a lot of the executing with you. But there's a side of it where like, you're going to get what you're going to get what you put in. And I think that's a big piece of it, right? Like there's not a lot out there that is like, hey, I'm just going to sit back and, my situation is just going to change because, I've aligned with somebody, that, is a tax strategist, right? Like there needs to be that buy-in on both sides. And those are like the true, like big success stories that we've had is that, someone's bought in, they're dialed in, they understand, they educate themselves, they listen to us. And, we're able to create a great situation because there's really nothing that is like, that's the old adage, like if it's too good to be true, it probably is, right? So there's nothing that's out there that's just like a silver bullet, apart from maybe infinite banking, Barry. That might be one thing that is too good to be true. But it's so that's what I would say. Like the buy-in, to really make it a focus, which I think is a step above just being proactive.
Wonderful. No, that's great. Great perspective there, John. So as we move to kind of wrap here, Barry, I have a final kind of question for you. So, at what stage of the journey is it ever too early? Like, what is an ideal scenario for you to work with? What type of clients do you like to work with? Is there a threshold that people should be thinking about in their heads? Hey, I'm a business owner making 100K or 500K. Like, how does the math work as far as that goes from your perspective? And how do people get in contact with you if they're interested in digging into this topic a bit more in depth than we went to today?
Yeah, first they would visit my website, focuswealthgroup.com, and I'm all over YouTube. My YouTube channel is at Wealth Optimized. Videos are constantly being posted, YouTube at Wealth Optimized. So I've done this for 25 years. I have clients in 49 states across the country, and I have a wide range. Some of my clients are putting $1,000 a month into a policy. I've got clients that are doing $200,000, $300,000, $400,000 per year into policies. The ideal client, we want to see someone between 20 and 55. Now, not to say that someone in their 60s or 70s can't get a policy, because I do have clients at those ages that do get policies, but the cash value doesn't grow as well, etc. So 20 to 50, obviously you must have some discretionary income, but you could range $1,000 a month to $500,000 a year. That's up to you. What I do is look at the overall financial picture that you have, and then we come up together with the premium amounts. A lot of my clients are sitting on cash. They'll not only do a monthly or annual premium, they'll also do a first year lump sum that will really turbocharge the cash value. In the example that I gave earlier of a $50,000 a year premium, client could put in another $100,000 or $200,000 or $300,000 on top of that in year one. And now they're earning interest and dividends on a larger cash value number. So lump sums are very popular because they can take a loan 30 days later and go invest in business or go invest in real estate. They're not locking up that money, but by funneling it through the policy, they're able to earn interest and dividends on the full amount. There's no lost opportunity cost when they take a loan. And overall, the policy looks better because there's more cash infusion in the policy.
Understood. That's great. Well, thanks for that background there, Barry. And John, I'll throw it to you to last here. So how do people get in contact with us at Anomaly CPA, and what are the kind of key characteristics from a business owner or real estate investor that we're looking for an ideal client?
Yeah, like Barry, we're very active on social media. So I think the main two places where you can you can take a look at everything that we do from content wise. Our Instagram, so our Instagram handles anomaly_CPA, and then same thing for YouTube. So we're very active on both channels there at anomaly_CPA. And then our website too, anomalycpa.com. That's the best way to get to contact us, right? We have kind of our call to action funnels on the website, so you can kind of go through those and get in touch with our team, and we can start kind of evaluating for a good fit and what makes sense going forward with what the services we provide. And to that point, I think that the people that we align with, we want to align with growing entrepreneurs, so growing entrepreneurial businesses and founders. We tend to work with businesses that are, more digital in nature. We're a completely remote company. Like Barry, we work in every state of the United States. We're not relegated to any geographic area. We have team members in a large portion of states. So we tend to work with companies that really don't have, your brick and mortar kind of infrastructure. We're working with kind of fast-paced, internet-based digital companies. So what we're doing for them is tax strategy, tax planning, really kind of driving home, a lot of return on their investment in that sense, and then making sure that they're ahead of the curve from a tax planning standpoint, year in and year out. And we're working also with those businesses, as it relates to accounting, making sure that they know their numbers, that their back office is completely sound. And we're really kind of handling things A to Z for them financially. We work with a lot of investors too, real estate investors I alluded to as well. I kind of neglected that point, but just really taking advantage all the value add opportunities there are in real estate, and trying to get them in touch with people like Barry, with the host of people that we are trusted partners that we work with. To get these things dialed in and make sure they're taking advantage of everything at their disposal.
Wonderful. Well, thanks for that, John. And thank you everybody for watching. And again, if you want to get in contact with us at Anomaly or Barry, please do so. Otherwise, Barry, thank you so much for the time. John, thanks for your time. This is great. And and hopefully we'll do it again soon.
Thank you.
Thank you, Greg. Thanks, Barry.